Hello, I'm Edric Keane from Edison. Joining me today is Matthew Clayton, CEO of Thrive Renewables, to talk about the company and its prospects. Matthew, welcome.
Thank you very much.
We start with an overview of what Thrive does. I mean, you've described yourself as a living proof that businesses can operate as a force for good. I mean, what does that mean, and what does Thrive do?
Yeah, okay. So Thrive exists for two reasons. One, to address climate change, do something practical about climate change, and secondly, to allow individuals and to empower individuals to do something about climate change. So it's in answer to those two missions, if you like, or the dual mission. We, in a very vanilla sense, we go out and build new renewable energy assets. So we build new renewable energy assets in the UK. We've got a combination of wind, hydro, solar, and as well as some geothermal and battery projects within the UK. And the way that we answer the challenge of putting people at the heart of those projects is by having a very diverse investor base. So we unite a community of over 6,000 investors. Like 23% of those are your high impact investors like Triodos and Lion Trust and people like that, and Rathbones. But the majority of our investors, 77%, are retail investors who want to do something practical about climate change. They invest in us, we combine that capital and go out and build new renewable energy projects.
And in 2022, I think you announced a significant growth plan, and you wanted to, I think it's double generation capacity, if that's right. Can you take us through why that sudden surge for growth?
Yeah, well, I guess the principal driver, I think for all of us, is the environmental imperative, as in we need to do something about climate change. Climate change isn't waiting for policy or economics to change. So principally it's driven by the environmental imperative. But in addition to that, we've seen an opportunity in that the change in government has been very favourable for renewables, so the political situation is very favourable. We've built a portfolio of over 170 megawatts of projects. We've got the skill base, we've got the capacity to do more and use that resource more efficiently, so that's part of the equation. And also we see the opportunity to build more in the UK. The renewables is currently delivering about 50% of the UK's electricity. That's been achieved remarkably over 30 years. To get to the 2030 targets and on to net zero, that kind of needs to double again.
Can you give us some examples of particular growth projects that you've got in the pipeline at the moment?
Yeah, so we're currently working hard on three particular projects. So there's a wind farm up in Scotland, a 57 megawatt wind farm, so about £90 million investment that we're building out at the moment. We've done the procurement on that, and we've started the construction on that project, and it's got a grid connection date due for very early in 2027, so that project will be generating in 2027. Similarly, we have a Welsh wind farm which we're building out at the moment, about £20 million asset, which will be generating again in Q1 2027. And additionally, we're just finalising the construction of a solar farm in Essex, which is a 15 megawatt solar farm, which will be connected to the grid and delivering this summer.
How do you think about technology diversification in that? You know, do you do that deliberately, or is it just really down to the opportunities that you've got?
Yeah, 10 years ago we took a very definite decision to diversify the portfolio, and that's sort of for two reasons. One of which is for operational resilience, as in the wind doesn't always blow everywhere in the UK at the same time. The sun doesn't shine as intensely at different places in the UK. So we've got that geographical diversity within the portfolio. But the other driver is regulatory risk mitigation. So there's a process revisiting the electricity market arrangements going on at the moment. There'll be winners and losers within that. So we think it's important to have a portfolio which reflects the future energy mix, because that's ultimately what the regulations want to deliver. So if we've got investments in all aspects of that technology, we should be able to capture value within that.
And your funding model is a little different. You've raised, I think, something like 63 million over the last 3 decades.
Yeah.
And you've got a share offer out at the moment. Can you give an update on how your funding model works and how your share offer is going?
Yeah, so we're, as you say, we're quite unique in a way in that we blend retail investment with institutional impact investment. So currently the capital raise we're undertaking at the moment, you're right, 5 million, principally from the crowd. We're expecting that to be raised from, and that capital will be deployed directly into the new projects I've just described, combined with the retained profits from the previous years to get those projects built. And we intend to continue to work with larger impact investors, principally issuing ordinary shares, so everybody's investing on the same basis. But additionally, we've got two co-investment vehicles operational at the moment, one of which is focused on the whole portfolio, so all of our renewable energy assets, and the other of which is focused on our community energy project development and funding.
You recently released FY24 results. Do you want to give us an overview of what they were like and maybe how you see the next year?
Yeah, so last year the turnover was 26 million with an operational profit of 12 million, which is a great year. In many respects, the last 2-3 years have been quite exceptional for us from a revenue and therefore turnover perspective, because the unfortunate events in the Ukraine with the Russian invasion have pushed up the European gas prices, which has an impact on energy prices. So we've had a couple of exceptional years of revenue on the back of that. But what we've sought to do is continue to provide a sustainable return to our investors. So we've offered a 12 pence dividend throughout that period, which equates to about 5% of the share price, so a 5% return annualised. But additionally, because we see it as exceptional, and we see that the potential to use that exceptional profit to invest in the future, we're retaining some of that capital to invest in the new projects and fund those. So just trying to make that really sustainable situation where we're providing a fair return to our investors and also investing in growth, changing effectively a 10-year business plan into a 30-year business plan.
And you talked earlier about the connection between policy and growth. I mean, how do you see the policy environment at the moment?
Well, yeah, I mean, it's a very interesting time to ask that question. I mean, I've been working in the energy sector for 28 years now, and if you'd asked me, this is the first time I genuinely feel we've got a government that wants to deliver on climate change. And so, yeah, you have to pinch ourselves a little bit. The limitations on planning in England have been taken apart, so we can now have a level playing field for planning across the UK for renewable assets and other assets. The grid queue, which is a really material issue for us as a sector, but actually for housing developers, property developers, for data centre developers, the grid is a really real constraint for us at the moment. And helpfully already the queue, so the grid queue, the queue for grid connections, is being reprioritised, and rather than it being attributed to the when a project applied for the grid, it's now being the prioritisation is being attached to the development stages of that project. So the more advanced projects can jump on the grid sooner. So that reprioritising will take a while, but that's really helping, and that's a really fundamental policy driver. And additionally, as I touched on earlier, there's a review of the energy market arrangements, and whilst that creates sort of immediate uncertainty as to where the value is going to sit and how it will lie, we take a lot of confidence from the fact that the principal reason for reviewing the energy market arrangements is to wean ourselves off of gas and into renewables. So as an investor and operator of renewables, we feel comfortable that we'll be on the right side of that development.
Matthew, thank you for joining us today. For any questions, direct investors to the Edison website for further content. Thank you.